Welcome to AI Talk Radio. Today we are diving into the complex, fast-paced world of options trading, with daily volumes hitting an astronomical 72.8 million contracts, driven largely by retail interest and zero-day-to-expiration contracts. We want to demystify how these financial instruments actually work. Joining me right here in our studio today are Sarah, Dave, and Marcus. Welcome, everyone. Sarah, let's start with you. How do we conceptualize a simple call option?
Thanks, Paul. So, think of a call option not as owning stock, but as like a real estate coupon. Imagine you pay, say, $5,000 for a non-refundable 3-month coupon to buy a house for $500,000. If the neighborhood suddenly booms and the house value jumps to $600,000, your coupon is worth what? At least $100,000? That's a massive return on your $5,000. But, if the market crashes and it's only worth $400,000, you let the coupon expire and you only lose your $5,000 deposit instead of losing $100,000 on the actual house.
A very clear illustration. And Dave, how does the other side of that equation look? How do put options fit in?
Right, exactly. And on the flip side, you've got put options. I always tell people to think of puts like car insurance. You pay a premium to protect your asset. If you own a stock and buy a put and the stock crashes, the put option pays off to cover that loss, just like insurance replacing a wrecked car. But if the stock goes up, sure, you lose that premium, but you're happy your car didn't get totaled, right? Your underlying stock gained value, so you're fine with losing the premium.
Indeed. Now, Marcus, there is a temporal element to these contracts that traders often struggle with. What is theta decay?
Exactly, Dave. But the thing people forget is, time. Options aren't forever. Holding a long option is literally like holding an ice cream cone on a hot summer day. It's just melting. We call this theta decay. Every single day the stock doesn't move, a bit of your options value just drips away. It accelerates like crazy in those last 30 days. If you're selling options, though, you're the one holding the bucket, collecting the cash while the ice cream melts in someone else's hand. Oh, totally. And that brings us to implied volatility, or IV. Think of IV like a weather forecast before a massive storm. Plywood and umbrella prices skyrocket because of the panic, right? That's Vega at work, tracking that storm pressure. But the second the storm passes, boom! IV crush. Prices drop instantly, even if it's still raining. That's why trading around earnings is so risky. The event happens, the uncertainty disappears, and the option value just implodes.
Yeah, it's a brutal cockpit dashboard. You've got Delta tracking your speed, Vega measuring the storm pressure, and Theta is the timer ticking down on your parking meter. With 72.8 million contracts trading daily now, especially those crazy zero-day options, retail traders they're getting hammered. 80 to 90% of retail options traders lose money because they're constantly buying out-of-the-money options close to expiration, fighting that melting ice cream.
Spot on. They buy these cheap lottery tickets, ignoring the math. If you want to survive, you've got to look at strategies like covered calls or cash-secured puts. We call it the wheel strategy. You generate income by being the insurance seller, not the buyer.
A highly compelling breakdown of a very volatile financial landscape. My thanks to Sarah, Dave, and Marcus for shedding light on the mechanics of the options market. That is all we have time for today on AI Talk Radio. Thank you for listening.